Coming up in this reading is a lot of theoretical content about the way in which the prices of derivatives differ from their valuation. And this is something which will be interesting and also important for us to understand compared to what you may have seen when studying fixed income or studying equity, where we do consider fair value of instruments and then say compare that to the price, obviously as an analyst, to determine whether it's actually worth buying or perhaps worth selling the asset. Well, derivatives can certainly use the terms price and value very differently from other types of assets, such as shares and bonds. It's important for us to understand why that is the case, and in doing so, we'll understand how derivative pricing will actually work and how the valuation will work at any given time. Ultimately, though, as we'll see, a derivative is a financial contract which derives its value from the performance of something else, something which is called the underlying. Generally an asset of some kind, like a share or a bond. It also may just be an interest rate, in which case it wouldn't be an asset, but would still be the underlying for the derivative. Now, the reading has a lot of learning outcome statements. You can sort of just glance at the screen there. Now, there is not really a need for calculation as such in this reading, but to explain and understand the various ways in which a contract of a derivative can be priced and valued. So we'll have to go through all of those concepts. The concepts are best probably explained, though, with a numerical example. However, we'll always state that such a numerical example will not be in your final exam. Right, so for having a look there, you can have a look at the learning outcome statements, the command words, as you can see. Explaining the concepts, distinguishing between prices and value. We will explain how to value contracts and indeed why certain contracts may differ from each other, although they may be similar. Contracts may trade over the counter, they may trade on exchange. Also, contracts may give certain benefits, some may give certain costs, which must be included in their pricing and ultimate valuation. We will look at all the various derivatives, including futures, forwards, swaps, and options. And particularly with options, we will look at models which will be called the put call parity model and the binomial model. We'll have some numerical examples, but yet again, it's more or less to understand how these models work as opposed to having to actually do any numbers in the exam. Right, so looking at the opening slide, everybody, we can see it's titled Types of Derivatives. Now, the first thing we should do is just use the time to write a definition of a derivative, which is common throughout the reading. We'll say a derivative essentially is a financial contract that derives its performance, so basically how it ultimately is being viewed, that derives its performance from the performance of an underlying. Now we'll use the term underlying asset, I think, at this stage, everybody, but as we said earlier a moment ago, the underlying may not be itself an asset. It may be, for example, a share on a company. It may well be a bond issued. It may well be a commodity, in which case we'd say it's an asset. But it may be like an interest rate, for example, a market interest rate like LIBOR, in which case we wouldn't really call it an asset, but it is underlying for a contract. And so we'll use the term underlying asset at this stage, but not necessarily say it doesn't have to be an asset. And thereby we actually do summarize that the financial contract itself can broadly be based upon the following types of underlyings. So let's just say, for example, the underlying for the derivative contract given by the reading can generally be segmented into one of the following categories. So, for example, of course, equities. We say shares, for example, of the S&P 500 or the FTSE 100 or the Nikkei 225. The share market is the underlying for the derivative. Alternatively, perhaps it's a government bond, a corporate bond, or maybe some kind of municipal bond, but some sort of fixed income instrument. And thereby, of course, what you really are trading there is the yield or the rates which are being used to value the bond. So when we look at fixed income instruments, we could say that, yes, looking at the yields or the rates in which the underlying is based on, you're having a contract which is related to those rates. Alternatively, it may be that the contract is based upon the currency market, so foreign exchange, dollar, sterling, euros, whatever it may be, the underlying happens to be the currency market. So currency. Now, the reading would certainly call these financial assets. All of these are assets of some kind, and the underlying will determine the value of the derivative at any given time. Alternatively, the contract could be based upon the commodity market. Commodities such as gold, or copper, silver, oil. That is regarded as a real asset. As you can imagine, it has tangible aspects of it, obviously, and is considered quite differently a bit later in terms of valuation. But the important thing is that it too can be the underlying for the derivative. Now, whether you have a financial underlying or you have a real underlying, the derivative contract can be broadly segmented into two categories. A derivative contract can be considered a forward commitment, number one. It can be considered a contingent claim, number two. Now these two categories basically tell us a little bit what the contract is asking of each side, each party. There'll be a trade done between two parties in this contract. If it's a forward commitment, it's an obligation for one party to buy and the other party to sell. The commitment is based upon a particular underlying. One party is going to be paying and one party is going to be receiving a certain amount for the underlying, and the terms are agreed today, but the trade happens in the future. Hence, we say it's a forward commitment. It's an obligation. An obligation to trade. In the future. And this obligation to trade can be found through an exchange traded mechanism, i.e. where both buyer and seller actually conducting a trade through an exchange platform and then find themselves obligated to each other. In which case, if we say it's on exchange, one type of forward commitment you can see here is called a futures contract. Now, futures contracts, folks, are considered to be always exchange traded, essentially, and therefore they will be very much regulated. We can think about major platforms such as the Chicago Mercantile Exchange, or indeed in London we have the London International Financial Futures Options Exchange, LIFE, London Metal Exchange, the LME. If we think of these platforms, the trades which happen on them can be done in futures contracts, where you'll have a very regulated and standardized contract. Both parties will know what the terms of the contract are. It's a question of do they actually want to get involved in it. But by trading, you are essentially agreeing to the terms and conditions implicit in the contract, and therefore you are committing yourself. But the traders themselves do not make the contract. It's made by an exchange which has listed the contract for everybody if they want to trade it. One party buying it, one party selling it. So as we'll see, futures are one type of forward commitment. There are others, but the others are generally found OTC, over the counter, which means that banks essentially are privately negotiating with their clients what their needs are, understanding their needs, and then designing a contract which meets their needs. Now, their need could be, for example, to bet or speculate on a market, try to make profit, or indeed to protect themselves from uncertainty, which we call hedging. In either way, the idea is that over-the-counter, privately negotiated contracts can be designed. But still, it's a forward commitment. So one party will be buying, one party will be selling at some point in the future based upon the underlying itself. And over-the-counter contracts, therefore, tend to be less regulated because they are privately designed. They're not meant for everybody. However, less regulation does, of course, mean potentially more risk, because the regulated markets, as we'll see, have credit risk management. A lot of margin or collateral will be taken to manage default risk of an exchange-traded futures contract, for example. Whereas when we look at things such as forward commitments, which are over-the-counter, we can see forward contracts are there. So a forward contract essentially is the same as a future, except that it's designed over-the-counter. So let's imagine it's a contract to buy and sell copper in 6 months at $7,000 a ton. The contract could be designed by an exchange and listed and traded on the LME. It'll be copper futures, or it could be designed by a bank for their clients, privately negotiated terms, same contract actually, 6 months, $7,000 a ton for copper, but it's designed privately, hence it must be called a forward. And the forward contract and futures contract, as we'll see coming up later, basically can be valued in very much the same way. And if we consider the methodology that you see, it's pretty much exactly the same. Swaps, however, are essentially a series of forward contracts. You are agreeing to trade not just once, but on multiple occasions. And swap valuation and pricing essentially is very much linked to forward valuation and pricing. We will see how they're connected coming up. But basically, it's an over-the-counter contract. A typical example in the world is interest rate swaps, where parties are swapping interest rate payments with each other, generally netting them off if they're in the same currency. Again, in all cases, the purpose of a forward commitment could be to bet or to indeed hedge your risk. On the other hand, we look at the other side, folks. We've got contingent claims. This is where we say the ultimate payoff will be determined by the outcome of the underlying. So the outcome of the underlying is, of course, not known. The underlying, for example, could be a share which may finish after 1 year above or below $100. And the contingency is saying, well, that's the thing, that's the contingent event. If the share price finishes above $100, well, then there'll be a payoff. If it doesn't, there'll be no payoff, for example. And so it's not a certainty that the contract will settle in anything. It may become completely worthless. It all depends on that event, which is not known for certain. And so the contingent event or contingent claim can be found on exchange. Once again, you can imagine that the contract, if it's found on exchange, will be listed by the exchange themselves. So it'll be standardized by them, or the terms will be set by the exchange. But it will be managed for risk through perhaps some kind of collateral management, some kind of credit guarantee given by the exchange. Highly regulated with some credit risk management. Or on the other hand, of course, it could be designed by a bank. It might be designed by a bank for their clients, in which case we'd say over the counter. And as usual, I'd say largely, you'll have a private negotiated contract with less regulation. And indeed, perhaps more credit risk, because this is not a standardized process. Examples given in the workbook, folks, or in the reading, do sort of cover things such as options, particularly on assets. So options on equities, options on bonds, options on currencies, which can be found on exchange and over the counter. Options on commodities, right? So all of the usual underlyings can be there. We can see we have sort of standard options on assets. You can find them both over the counter and on exchange. You could have options on LIBOR. We could have options on Euribor. anything you like, really. Of course, interest rates, as we know, are a form of underlying as well. Not an asset, but they still are an underlying, which the option could be based on. We'll look at options in some detail coming up. That'll be the main focus. Other types of contingent claims are included in contracts such as warrants, which we don't go into any great detail in this reading. In fact, we're just going to mention that that is a type of option, really, on shares issued by companies. There is an example of callable bonds and convertible bonds. Now, these are bonds, clearly, which have what you would call embedded options in them. And we'll see that that option may be useful or may not be, depending on a certain event, an outcome, which will be linked, no doubt, to the bond market in that case. But trade on exchange, as opposed to over-the-counter contracts like asset-backed securities. So perhaps a security backed by a pool of mortgage payments or backed by a pool of loan repayments, in which case the contingent event might be that the original borrower might actually prepay on their loans and shrink the size of the asset pool. There are credit derivatives, such as credit default swaps, whereby a particular person is looking to protect themselves from a credit event and is paying for that up front, but the outcome, or the value of this actual contract is depending on the outcome of the credit event. Did it happen? Did it not happen? There are also all types of other exotic options, which basically just means the contract contingent event can be much more complicated than simply saying there's an asset price finish above or below a certain point. Lots of complexity can be brought in over the counter, which we do not go into though at level 1.